AG here. If you thought the disconnect we saw on February 24th was alarming, February 25th just proved that we have entered a completely new paradigm for the silver market. Today, I am going to show you data that confirms the global silver market has effectively split in two. This is no longer a divergence. It is a divorce. We are witnessing a historic confrontation between the paper market in the West and the physical market in the East, and the physical market is winning. The data from February 25th, 2026 is screaming that the pricing mechanism we have relied on for decades is broken. While the Western exchanges struggle to keep prices near $90, the East has blasted through the ceiling, taking silver above $110. This isn't just a gap, it is a chasm. And understanding why this is happening is the key to protecting your wealth in the coming months. The system is under stress, the arbitrage is dead, and the physical metal is telling a story that the algorithms are trying to suppress. Let's look at the numbers, because they don't lie. On February 25th, the Shanghai Futures Exchange reopened with a vengeance. Silver didn't just inch higher, it exploded. We saw a surge of 6.5%, pushing the price firmly back above the critical 110 per ounce mark. Let me repeat that, $110. In a world where the COMEX price is hovering around $90, Shanghai is trading at a massive premium. Reports indicate that the spread between the Shanghai price and the COMEX price widened to over $7 an ounce at times, and in specific physical markets, that premium is being estimated as high as 40% to 50%. This is not a minor discrepancy. This is a total rejection of the Western pricing model. The message from Asia is loud and clear. They do not care what the paper price in New York is. They are valuing silver based on their own reality, a reality of scarcity, industrial urgency, and strategic hoarding. Meanwhile, in the West, the COMEX market put on a pathetic display of relative strength. We saw silver futures claw their way up to around $90.73, a gain of about 4.16%. On the surface, a 4% gain looks good, but compared to the 6.5% surge in Shanghai, it is weak. It is lagging. It is failing to keep up with the physical reality. Why is COMEX so sluggish? Because it is fighting the currents of margin hikes and algorithmic suppression. The paper price is being managed, massaged, and manipulated. The CME's emergency margin hike from the previous day is still hanging over the market like a dark cloud, suppressing the leverage that would normally drive prices higher. So, while the physical metal in Asia is responding to supply and demand, the paper metal in America is responding to regulatory fear. This is the definition of a broken market. Two prices for the same asset, determined by two completely different sets of rules. We need to understand why Shanghai is at $110, while COMEX is stuck at $90. The answer lies in the physical demand coming out of China. This isn't just speculation. This is industrial survival. China is the manufacturing heart of the world, and their green energy transition is consuming silver at a rate that the mines cannot match. Solar panels, electric vehicles, high-tech electronics. Silver is the blood of these industries. The Silver Institute has confirmed that we are in a structural deficit. Mine production is flat or falling, while industrial demand is skyrocketing. This deficit is being felt most acutely in the East. When Shanghai inventories are draining to critical lows, as we discussed previously, the price has to rise to ration the remaining metal. That is exactly what we are seeing. The $110 price tag in Shanghai is the pain price. It is the price where demand starts to destroy itself because the metal simply isn't there. The physical market is efficient. It is finding the true clearing price. In contrast, the COMEX market is inefficient. It is detached from this reality. The COMEX price is being set by traders, betting on currencies, betting on interest rates, or betting on what the Federal Reserve will do next. It is not being set by people needing silver to build solar farms. This creates a dangerous illusion. If you are an investor in the West looking at a chart that says $90, you might think silver is expensive, or perhaps fairly valued. But if you are a manufacturer in Shanghai looking at a price of $110, you know that silver is scarce and getting scarcer. You are willing to pay that premium because you need the metal to keep your factory running. This is why the physical market always wins in the end. You cannot hedge a physical shortage with a paper contract. Eventually, the paper contract has to be settled, and if there is no metal, the paper becomes worthless. The most frustrating part of this entire situation, and the part that proves the system is rigged, is the failure of arbitrage. In a normal free market, if silver is $90 in New York and $110 in Shanghai, arbitrageurs would flood in. They would buy every ounce they could find in New York, ship it to Shanghai, sell it for a $20 profit, and repeat the process until the prices converged. This action would drive the New York price up and the Shanghai price down. But we are not seeing this. Why? Because the arbitrage mechanism is broken. First, you can't ship paper futures. You can't take a COMEX contract and drop it off in Shanghai. You have to take physical delivery. And getting physical delivery out of the COMEX is becoming notoriously difficult. The inventory just isn't there in the registered category. Second, there are massive logistical bottlenecks. Shipping, insurance, and refining take time. But the biggest factor is the global supply crunch. There simply isn't enough loose silver in the West to satisfy the demand in the East. The metal is already in strong hands. The holders of physical silver in the West see what is happening in the East. They see the 110 price. They are not going to sell their metal into the COMEX paper market at $90 just so an arbitrageur can make a quick buck. They are holding, waiting for the global price to catch up to Shanghai. This behavior is what I call the death of manipulation. For years, the paper markets have been used to suppress the price of silver. Banks would sell short massive amounts of paper silver, creating an illusion of abundance to keep prices low. But physical demand is now so strong that it is killing this manipulation. When you have a line of buyers out the door in Shanghai willing to pay $110, the sellers in New York are no longer willing to play along. They withdraw their metal from the market. The inventory levels drop. The offer disappears. This is what breaks the manipulators. They can sell infinite paper contracts, but they cannot deliver infinite metal. Once the physical market goes into offer-only mode, the paper shorts are trapped. They have to buy back their contracts at whatever price the market dictates or face default. We are seeing the early stages of this trap on February 25th. The fact that the premium is widening despite the CME's attempts to cool things down proves that the physical buyers are in control. Let's talk about the implications of this $110 versus $90 split. This is not just a number on a screen. It is a fundamental breakdown of the price discovery function. Price discovery is supposed to tell us how much an asset is worth so that businesses can plan and investors can allocate capital. When you have two prices differing by 20% or more, price discovery is dead. Imagine trying to run a business when your cost of raw materials could be $90 or $110 depending on which phone call you make. This creates chaos. For industrial users, this is a nightmare. They are being forced to pay the Shanghai premium to secure supply, which drives up the cost of everything they make: solar panels, electronics, cars. This inflationary pressure is going to ripple through the global economy. The cost of the green energy transition is going up because the key ingredient, silver, is becoming repriced by the physical market. For investors, this creates a massive opportunity, but also massive risk. The opportunity lies in understanding that the COMEX price is the fake price and the Shanghai price is the real price. If you own physical silver, you are effectively holding an asset that is worth $110 on the global market, even if your local dealer is still quoting you $90 based on the COMEX fix. It is only a matter of time before the local dealers adjust their prices to reflect the reality of the global physical shortage. The risk, however, lies in the paper market. If you are trading futures or ETFs, you are tethered to the $90 price. You are betting on the manipulated number. If the system breaks and the COMEX is forced to settle contracts in cash rather than metal, you could get paid out at a price that has nothing to do with the value of the metal you thought you owned. You win the trade, but lose the purchasing power. We also need to look at the structural shifts driving this. The center of economic gravity is moving east. The dominance of Western financial institutions in setting commodity prices is being challenged. The Shanghai Futures Exchange is no longer just a regional market. It is becoming a global benchmark. When SHFE trades at $110, that isn't just a Chinese price. That is the price of silver in the world's largest industrial economy. It reflects the real consumption of the metal. The West is becoming increasingly detached from the real economy, trading paper back and forth while the East consumes the actual resources. This decoupling is a symptom of the broader fragmentation of the global financial system. We are seeing the formation of a dual economy, a paper economy in the West, inflating away, and a physical economy in the East, hoarding resources. The Silver Institute's data on the supply deficit is the fuel for this fire. We have been running a deficit for years. We are consuming more silver than we mine. The difference has been made up by recycling and by draining above-ground stocks. But those stocks are running low. The Shanghai inventories hitting record lows is the canary in the coal mine. Once the above-ground stocks are depleted, the deficit must be resolved by price. The price has to rise high enough to destroy demand. That is the only solution. And given how critical silver is to the green energy revolution, the destruction of demand point is much higher than most people think. Governments are not going to stop building solar panels because silver gets expensive. They will just pay more. They will print the money to buy the silver. This is why the upside potential for silver in the physical market is so explosive. So, where do we go from here? The market on February 25th has given us a roadmap. We are heading for a hard landing scenario. The gap between paper and physical is not going to close gently. It is going to snap shut. The tension is building like a tectonic fault line. We have the COMEX price around $90, suppressed by rules and regulations. We have the physical price around 110, driven by scarcity. Eventually, the physical market will simply refuse to sell at the paper price. The miners, the refineries, the hoarders, they will stop looking at the COMEX screen. They will look at the Shanghai screen. They will look at the physical bids. When that happens, the flow of metal to the West will stop entirely. The COMEX will have no inventory to deliver against its contracts. When that moment comes, and we are closer than people think, the paper price will have to explode upwards to try to lure metal back. It won't be a 6% move. It won't be a 10% move. It will be a vertical spike. We are talking about a revaluation event where silver attempts to price in the years of suppression and the reality of the supply deficit in a matter of days or weeks. The $110 price in Shanghai is just the opening bid. If the Western paper market collapses, the global price could converge much higher, as panic buying from the West meets the tight supply in the East. This is why I'm telling you to ignore the noise. Ignore the margin hikes. Ignore the temporary dips in the paper price caused by algorithmic selling. Look at the $110 number in Shanghai. That is your truth. That is your signal. The data is clear. The structure of the market is broken. The arbitrage is dead. The physical supply is vanishing. The confrontation between paper and physical has entered the endgame. The paper market is fighting a losing battle against the laws of physics and economics. You cannot print silver. You cannot code it into existence. It has to be mined, refined, and delivered. And right now, the delivery part of that equation is failing. We are watching a historic transfer of wealth. Those who hold paper claims are going to see the value of those claims diluted or defaulted upon. Those who hold the physical metal are going to see the value of their holdings repriced to the reality of the Shanghai market. This is the big short moment for silver, but in reverse. The physical longs are about to be proven right in a spectacular fashion. The data from February 25th confirms that the physical market is seizing control of the narrative. The 6.5% surge in Shanghai was not a random event. It was a declaration of independence from Western price manipulation. The industrial users in the East have realized that they cannot rely on the COMEX for their supply security. They are taking matters into their own hands, paying up to secure the metal, and in doing so, they are breaking the backs of the paper shorts. Do not get caught off guard. This is moving fast. The spread is widening. The inventories are dropping. The stress in the system is palpable. When the reset comes, it will be swift and violent. The price of silver will no longer be determined by the number of contracts traded on a screen in Chicago, but by the number of ounces available in a vault in Shanghai. And right now, the vault is empty. The only direction for the price to go, once that reality is fully priced in, is up, way up. Stay tactical, stay physical. The paper house of cards is trembling. On February 25th, the wind blew a little harder, and the cracks are showing for everyone to see. AG out.